So let's summarize. Very simply, the stock market is not a casino. It's a place to own businesses. You don't need to be rich. You don't need to be smart. You need patience and discipline. The biggest risk is never starting. In this video, we talk about stock market. First question raised in beginner minds. What is stock market? Let's start. People think the stock market is scary. They imagine numbers flying, red screens, people shouting, money disappearing. But the truth is simpler, much simpler. The stock market is not a monster. It's a system you already use every single day. You just don't realize it yet. Pause. Think about this. When you buy a phone, when you drink coffee, when you wear shoes, you are paying companies. Those companies grow because people like you exist. Now here's the question. What if you could own a tiny piece of those companies? What if, instead of only spending money, you could make money with them? That is the stock market. And today, I'll explain it from absolute zero. No jargon, no pressure, no finance bro language. Just a simple story. Let's start with something very small. Imagine a lemonade stand, a simple one. A table, some lemons, a few cups. The owner wants to sell lemonade, but there's a problem. They don't have enough money, so they ask friends for help. 10 friends, each gives $10. Now the stand has $100, enough to buy lemons, cups, a sign. In return, the owner says something simple. If this stand makes money, I'll share the profit with you. That promise is everything. That promise is a share. A share simply means ownership. Not full ownership, just a small piece. When you own a share, you own part of a business. That's it. No magic. The stock market is just a place where these shares are bought and sold. That's the foundation. Everything else is noise. Now let's zoom out. Big companies work the same way. Apple, Google, Coca-Cola. They all needed money to grow. Factories, employees, technology. Instead of borrowing everything, they sold small pieces of themselves. Millions of tiny pieces. Shares. People bought those shares. Why? Because if the company grows, their piece becomes more valuable. If the lemonade stand sells more lemonade, your share becomes worth more. If it sells less, your share becomes worth less. That's the deal. Risk and reward. This is where fear enters. People hear risk and panic. They think the stock market is gambling. But gambling and investing are not the same thing. Gambling is guessing. No control, no ownership, no long-term plan. Investing is ownership. You choose real businesses. Businesses with products, customers, revenue. When you buy a share, you're saying one thing. I believe this business will exist in the future. That's not gambling. That's judgment. So why do prices move so much? Why does the market feel crazy? Because the market is made of people. People feel emotions. Fear, greed, hope, panic. When people feel optimistic, they buy. Prices go up. When people feel scared, they sell. Prices go down. Nothing mystical is happening. It's just human psychology playing out on a screen. That's why news headlines move markets. That's why rumors cause crashes. The market is emotional, but businesses are slow, and that difference matters. Let's talk about crashes, because this scares beginners the most. You hear words like market crash, recession, financial crisis, and it feels like the end of the world. But look at history. Markets fall, markets rise, again and again and again. Crashes are sharp, recoveries are slow, but they happen. Why? Because humans keep working, buying, building, innovating. Businesses adapt. Weak ones fail, strong ones survive. The market is brutal short-term, but forgiving long-term. That's a key lesson.
Now, here's the mistake beginners make. They treat the stock market like a slot machine. They want fast wins. They buy because everyone is excited. They sell because everyone is scared. They do the exact opposite of what works. Smart investors are boring, very boring. They buy when things feel uncomfortable. They hold when things feel boring. They ignore noise. They focus on time. Time is the real advantage. Let's talk about compounding. This is where real wealth is created. Imagine this. You invest $1,000. It grows by 10% in 1 year. Now you have $1,100. Next year, it grows again by 10%. But now it's 10% of 1,100, not 1,000. Your money is earning money, and then that money earns money. Slow, quiet, powerful. This is why time beats timing. Starting early matters more than being perfect. Now let's address a big myth. You need a lot of money to invest. You don't. You can start with small amounts. What matters is consistency. Small money invested early beats big money invested late. Always. The stock market rewards patience, not intelligence, not luck. Patience. Another myth. You need to watch the market every day. You don't. In fact, watching too much often hurts performance. The best investors check less. They build systems, automatic investing, long-term thinking. They don't react to every headline. They understand something simple. The market goes up not because of news, but because businesses grow over time. Now let's talk about indexes, because this simplifies everything. An index is just a group of companies. Instead of picking one stock, you buy many at once. The S&P 500, for example, represents large U.S. companies. When the economy grows, the index grows. Indexes reduce risk. They remove guesswork. They let you bet on progress itself. For beginners, indexes are powerful, simple, diversified, and effective. Diversification matters. Owning one stock is risky. Owning many spreads risk. If one fails, others can succeed. This is why professionals diversify. Not because they're scared, because they're realistic. No one knows the future. Diversification is humility. Now let's talk about psychology. This matters more than math. Most people don't lose money because of bad investments. They lose money because of bad behavior. They panic. They chase hype. They quit too early. The market transfers money from the impatient to the patient. That's not a joke. That's how it works. Let's look at a simple example. Two people invest the same amount. One panics during crashes. The other stays calm. 10 years later, the calm investor wins. Not because they're smarter, because they didn't sabotage themselves. Emotions are expensive. Discipline is profitable. Now let's talk about inflation, because this is the invisible enemy. Money loses value over time. Prices rise. What cost $1 years ago now costs more. If your money sits still, it quietly shrinks. Investing is how you fight inflation. Not to get rich fast, but to avoid getting poorer slowly. That's an important mindset shift. The stock market is not about beating others. It's about protecting your future, retirement, freedom, choices. Money is not the goal. Time is. Investing buys time. So how do you start? Slowly. Learn the basics. Understand what you own. Avoid hype. Avoid shortcuts. Avoid guaranteed returns. There are no guarantees, only probabilities. And patience improves probabilities. Here's a simple rule. If you don't understand a business, don't buy it. If you panic easily, own diversified funds. If you want excitement, use a small portion. Protect the core. Speculation is entertainment. Investing is strategy. Now let's talk about long-term thinking. The market rewards people who think in decades, not days, not weeks, decades. This mindset removes fear. Short-term drops stop feeling scary when your goal is far away. Zoom out. Always zoom out. Another key lesson: the market does not move in straight lines. There will be drops, corrections, crashes. These are features, not bugs. They clean excess. They reset expectations. They create opportunities. Fear creates value. Greed destroys it. You don't need perfect timing. You need consistency. Invest regularly, ignore noise, let compounding work. That's how ordinary people build extraordinary outcomes. The stock market is not a game. It's a long journey. And the earlier you begin, the smoother the ride becomes. Take this knowledge. Let it sit. Let it grow.